Over the last 12 months, I've invested £975 per month in my Trading 212 Stocks and Shares ISA account, and the aim of today's video is to share that experience with you. I'll give you an insight into how my portfolio performed, I'll share with you my investment framework, and I'll give you a breakdown of all of the interesting data points too. But before I do so, this video is for educational purposes only and is not financial advice. Nothing within this video is an investment recommendation. Always do your own research, and when investing, your capital is at risk. Okay, so no messing around, let's jump straight into how the portfolio has performed. 12 months ago, my investment portfolio was valued at £65,809. Fast forward 12 months, and I can't quite believe I'm saying this, but my Trading 212 Stocks ISA is now valued at £93,369 and has generated a rate of return of 22.5%. which is the equivalent to an unrealised profit of £16,052 just within the past 12 months. That's almost the equivalent of a salary of tax-free money that I can withdraw from my investment portfolio tomorrow if indeed I decided to do so. Now, short-term gains like this can certainly feel exciting, but it's also important to remember that investment values can rise as well as fall. As I'm about to show you, it's not been all plain sailing in 2025. Whilst 2025 has finished strong, there were points in the year that were far more difficult, with the portfolio actually being down in excess of £11,000. So now let me share some of those performance and data insights with you, and I'll break down what has been a little bit more of the details behind a volatile year in the stock market. So here's the portfolio performance over the past 12 months on a month-by-month basis. February, March and April were all tough months, with 3 consecutive months of back-to-back losses that racked up to be about £8,000 when comparing the opening balance in February to the closing balance in March. This was as a result of Donald Trump's tariffs. They seem like a distant memory now, but at the time it resulted in the S&P 500 sinking 18.9% and resulted in the decline of the global stock market to the tune of 15.75%. Now, these specific market conditions are considered as a market correction, where the markets decline anything between 10% and 20%, as a decline of 20% or more would be considered a bear market. But here's the thing, market corrections actually occur quite regularly, and historically, they've always been temporary. Analysis from Covenant Wealth Advisors mapped out all of the market corrections of the S&P 500 which have been experienced since World War II, and they found that they occur roughly every 1.2 years on average. And also in a similar light, they also analysed that the average market correction takes about 4 months or so to recover. So whilst it certainly wasn't a great time for my investment portfolio, certainly in the moment or within that space of a couple of months or so, I also felt that it was also an opportunity that was being presented too, especially as I'm a long-term investor. So now let's take a little bit more of a look of that performance in the preceding months thereafter. In May, June and July, I experienced some huge gains in the value of the portfolio, a strong turnaround gaining £15,612 in portfolio value. That was partly thanks to Trump entering into negotiations with the UK, China and Europe, which resulted in the market rallying. It just shows how quickly that markets can change for the better or the worse based on macroeconomic factors that are certainly out of our control. The portfolio recovery though was also helped on by the fact that I actually invested about £2,500 in March whilst the markets were down. A significantly higher amount than I normally would on a month-by-month basis, but there was a very good reason for that. As a longer-term investor, when markets decline like we saw in March, either into a market correction or a bear market, it gives me the opportunity as an investor to lower something called my cost basis. This essentially means that I can buy more shares of the same investment but at a lower price. Now when markets recover, which obviously they have done in this case, my slightly lower cost basis then allows me to amplify my gains. For additional context, in January, I made an investment in the Vanguard VUSA S&P 500 ETF, purchasing 9 units for £840.51. This was an average price of £93.39 per unit. Fast forward to March, where I made my biggest investment of £1,482.39, picking up 18 units of the same fund, but this time the average price was £82.35 per unit. That's exactly what I mean when I say I was able to lower my average cost basis, with the units that I bought in March being on average about 10 or 11 quid cheaper than what they were in January. And it was a strategic play that in hindsight I'm very proud that I had the confidence as an investor to be able to execute on. But as I said, I'm a long-term investor with time on my side to be able to allow markets that time to be able to recover. And even if the markets dropped even slightly more than what they did in March, I still would have done exactly the same thing. I guess this time though I was fortunate that markets didn't decline too far and that they'd actually recovered by the end of June. About 3 months or so from absolute market lows, which was actually a slightly quicker recovery than average. As the tariff story settled, so did my investment portfolio, with gains now starting to be made across June, July, August, September, and then with a huge month in October. October was a month full of earnings reports from companies like Microsoft, Apple, Meta, and Amazon, who have all been major players in stock market growth in 2025. And with a growing concentration risk amongst these top tech stocks, the stock market is ever more reliant on the performance of the Magnificent Seven, with them now accounting for 36% of the entire US market value, according to reports from the Financial Times. And based on this research paper from Goldman Sachs called The Concentration Conundrum, you can see how the concentration of the top 10 in the S&P 500 has been growing rapidly since 2015. I guess one of the reasons for this, and this is obviously based on most recent data in 2025, but the Magnificent Seven have actually made up 60% of the gains in the S&P 500 index since the market bottomed in April, but they've also contributed almost 80% in the S&P 500's net income in the last 12 months too. So it just shows how critical market performance is to the success of these companies. You can kind of see how this has played out when we look at an equal weight S&P 500 index fund, whereby the asset allocation of all of the stocks within it are completely equal, versus a S&P 500 weighted fund, whereby the asset allocation within the fund is weighted based on the market value of the individual stocks. Over the last couple of years, and particularly since the market declined earlier in 2025, you can see just how much the weighted index in blue has outperformed an equally weighted index in green, which I think just highlights how important those handful of stocks are to the continued growth of the US stock market. And then there was last month, the worst month in the stock market since March, with the portfolio being down 3% or £2,907 for the month. It'll be interesting to see what December brings us in terms of market returns, but ultimately, I think we can say that this year has been a very good year within the stock market, with the S&P 500 being up 13.26% this year, and the FTSE All-World Index being up 16.45%, showing another strong performance for equity markets. It is worthwhile noting though that the returns that we've seen this year are higher than that of the longer term averages, with the S&P 500 having average market returns of about 9% versus the FTSE All-World, which is about 10%. But of course, past performance is no guarantee of future results, and just because we've seen a good year in the market this year, nobody knows what next year will bring. Now, before we dive into some other portfolio insights, like how much I've made in dividends this year, first I wanted to introduce you guys to today's video sponsor, which is Trading212. Trading212 are a commission-free investment platform who I've been using for the past 5 years now, and they allow you to invest completely tax-free using their stocks and shares ISA account. They have a range of different investments available, from global equity ETFs and thousands of different stocks on their platform. Using their pies feature, you can select and add investments based on research that you've done, with an asset allocation that you're comfortable with, while setting up automatic investments to make investing as passive as possible. Now, to help you guys get started, Trading212 are kindly offering all of my subscribers one free fractional share valued up to £100 when you scan the QR code here and open an account, or you can click on the link down in the description below. And once you've opened your account, all you need to do is deposit £1 to qualify for that free fractional share. Alternatively, if you've opened an account within the past 10 days, you can use the promo code Mitch and you'll still qualify for that one free fractional share. Thanks again to Trading212 for sponsoring this video. Okay, so another thing that's contributed to my portfolio gains so far in 2025 has been the dividends that I've gone on to receive. Now, my portfolio certainly isn't one of these high dividend yielding portfolios, and as a result, I've only generated £378.78 from dividends. And here's how much I've been paid each month from them. Certainly not huge, with the biggest single month being in July, where I made £126.67. But of course, it's certainly better than nothing, and it's definitely an added bonus. Now, I benefit slightly more from these dividends because I don't just withdraw them and spend them willy-nilly, and instead, I follow something called a DRIP, or DRIP, which stands for a dividend reinvestment plan. And it's whereby I simply reinvest all of the dividends back into my investment portfolio for future long-term gains. It all helps with the power of compounding, and to help demonstrate this, I've actually found a bit of research from Hartford Funds called The Power of Dividends Past, Present and Future. And it shows the growth of $10,000 from the 1960s in an S&P 500 index and compares the results from reinvesting dividends versus not receiving any dividends at all. The results show in this 64-year time period, a portfolio with dividends reinvested would be valued at $6.4 million versus a portfolio that didn't receive dividends of just $982,000. So 6 times the portfolio size, just showing the true power of compounding when dividends are reinvested over the long term. But there's one other reason why my portfolio has performed in the way that it did, and that's down to my asset allocation. So let's take a look at that next. 50.34% in stocks and 49.4% in diversified ETFs. However, if I layer in the stocks ISA, which I also have over on Vanguard, this changes the allocation to 57.47% in ETFs and 42.22% in stocks. This, I will say, is a very aggressive approach to my investment portfolio, and I've actually looked to try and de-risk my portfolio over the past 12 to 18 months or so, reducing my exposure to those individual stocks and putting more money into diversified ETFs. To help with that, I realized some of the gains that I'd made on those individual stocks by selling the equivalent to £5,007.31 at the start of the year, thankfully just before the market sold off. All of that money was then reinvested into diversified ETFs in order to help rebalance my investment portfolio and operate a little bit more closely in line with my overall risk appetite. However, driven by such strong performance in the individual stocks in which I've held this year, that asset allocation has started to creep up again. I think it's important to say here that asset allocation and risk appetite are super important to understand when you're constructing your own investment portfolio. To help demonstrate how one could structure an investment portfolio, I recently stumbled across a paper called Behavioral Portfolio Theory. It was written back in 1997 and it focuses on a 2-layered approach to portfolio management, in that you have a downside protection layer to prevent financial disaster. This would be the core part of your portfolio. And then you have an upside potential layer known as your satellites, designed for a shot at becoming rich. Now, I think historically my portfolio's asset allocation has been a little too geared towards those satellites, so those individual picks that I've found to be more favorable. And actually what I'd like to do is start to build out the asset allocation a little bit more to the core part of the portfolio. The reason for this is that it increases my diversification and it allows me to be perhaps a little bit more passive towards my investment portfolio, especially considering when you're picking individual stocks and themes and becoming a little bit more active, as we've seen from lots of the data sets, that roughly 90% of active fund managers actually just fail to beat the market index over time. I guess this is where overall portfolio management comes into play and the underlying importance to review my investment portfolio periodically. And that's to ensure that the portfolio is still within my risk appetite, and also to ensure that the portfolio and its asset allocation hasn't become completely imbalanced, which I think makes now at the end of the year a good point of reflection in order to ensure that I make those necessary adjustments and changes into the new year. Of course, my investment portfolio isn't perfect and it's still a work in progress, but if you did find this video useful, be sure to subscribe to the channel as well. Let me know down in the comment section below. And whilst you're over here, YouTube thinks that you should watch this video next. With that being said, I'll see you over in the next one.